Good morning, beautiful people of the internet, and welcome once more to the Sunday Special Live. We are joined by the Oracle of bankrupt Birmingham. We are joined by Mr. Piotr, Rusinek, the Oracle of Awareash. We're joined by me, no Oracle, but I'm trying my best. We normally have Helen, but Helen is on an alternative flight. She missed the flight, so she's heading back to Malta. And look at the timing. Mr. Safe Dersey joins us. So, by no means a replacement, and certainly not lesser. Just a good chance to have Safe back on. People seem to enjoy that as well. So, I thought we would kick off this week, firstly by going through the cliff notes of the Adam's supplement, but then also maybe a quick chat about how both of us found the judging this year for the Property Investor Awards, considering it's your first year, Adam. Well, that might be an interesting topic to run through. My day was eventful. I can imagine yours was no less eventful, although I feel like I may have missed out.
Yeah, it's a shame you weren't there. It is a shame you weren't there.
Yeah.
Good fun. Good fun. But before I get myself into trouble live on camera, so supplement this week, I've gone quite heavily into a couple of pretty data-rich reports that I wanted to really highlight to everybody who reads and listens along. The first one is about the FCA. From the FCA produced a quarterly report about mortgage lending data. It is the best single report that exists by a million miles. Most of the rest of the stuff that you see commentary from or on is from one lender or another. And even though you have lenders like the Mortgage Works, backed by Nationwide, of course, who do a lot of lending, it's a very, very fractured marketplace, buy-to-let and residential property lending in general, very fractured. So there's certainly no lender that's got more than about 15% of the market. So you don't really want to be relying on their reports to draw any significant conclusions from. So that was very illuminating, because I was a little bit surprised that quarter two's buy-to-let lending was even lower than quarter one's. But there is a big stat that I saw this week from Rightmove that the average property is now taking 150 days to completion from 100 days. So there's a 50% increase in how long it's taking within, this is post-pandemic stuff that's being blamed. So it's a bit of a weird thing, isn't it? You've got sort of AI and all these arguments on the one side for making it faster, and you've got the reality where it's actually become 50% slower in the last few years. So part of that Q2 hangover you could probably blame on the Liz Truss effect and all the rest of it. But to be down on quarter one's lending, so it only took 8.1% of the mortgage lending market for buy-to-let, which is the lowest number for 13 years. You're really looking at a very, very, you're looking at post 2008 style mortgage take up at the moment. That really is the only comparable figures that there are. Now, why is that? Well, it would be fair to say that the price of credit shooting up as much as it has is as good a proxy for the near total withdrawal of credit as we remember in 2008 or 9, more accurately. In those days they were back down in the 6% rather than the 8%, but still very low. And I'd expect quarter three to pick up a bit, because there were some reasonable rates available in quarter one of this year. So if you lag them forward 6 months, there should be a few completions. But by that same logic, I think quarter fours will look pretty rubbish as well. And the really, really important stat that I think I drew from that report was around where the cash buyer volume is versus the mortgage buyer volume. So that actually came from the Zoopla rental report from September. And that rental report confirmed that cash buy volume is down 1% year on year, whereas mortgage transaction volume is down 28% year on year. And that tells you the difference that the hikes up in the cost of credit have had. So, September 22's report for Zoopla, you'd expect to have had no Liz Truss effect, although it would have been dealing with the fact that the swap rate had been tickling up quite steadily over the course of 2022 up to September, where it just went bonkers. So the cash buyers aren't on the sidelines. You know, they're still transacting at the sort of pace that they were. And that's cash buyers, not to be clear, not just across investment property, but across all property. So you haven't got people hanging around waiting in the wings. What you've got is frustrated buyers at the moment, buyers who've been frustrated. You had buyers who were facilitated and enabled by very cheap credit, and now you've got frustrated buyers. And of course, the nature of this cycle is we've spent quite a bit of time talking about where people are at as they drop off their mortgages, but the bank figures have proved that that's not a really major part of the marketplace at all at the moment. That's going to happen over the next 1, 2, 3 years. So we're not really seeing the impact of all of that just yet. We're just seeing frustrated buyers. What's it meaning? It's meaning that people stay at home longer, and it's meaning that there's more sharing of properties going on. So the amount of room you've got per capita, per person, is shrinking. It's already very low in inner London, which won't surprise anybody, of course, and the affordability is already pushed to a very significant high. But that's the big stuff that came out of there. A real, not collapse, but we're 40% below the 10-year average in investment mortgage lending in Q2 of this year. And that, to be clear, includes personal name and limited company. They've got all the data from the top lenders. They don't worry about distinguishing between the two. So there's limited worries about the data quality, which I spend far too much time obsessing over, as I think you guys know. And yeah, what else did Zoopla say? Interestingly, if at a really simple level, now bear in mind this is a slightly alternative viewpoint, although it is something that the ONS have shared this year. The ONS see the market as flat at the moment, although they're always a few months behind in their data dropping through. Whereas Halifax and Nationwide are averaging about 5% down year on year at this point. And there's an element to which they forecast forward, although we don't understand and know about their methodology because they're not transparent about it. You'd obviously expect the ONS to have the best data. But I've said in the supplement this week, I found a new respect for Zoopla this year because some of their data quality is really solid. And they are reporting a 0.1% drop year on year. So very different from the reported 5% drop from those lenders. Now, I think, as always, it's the old 6-foot man in the 7-foot river on average. In the 5-foot river on average who drowns, because it's the bumps that do you, not the averages. But the big sort of generalised conclusions that you can draw from the Zoopla report are, firstly, the south are where the incidence of most of the price drops are, and you kind of expect it because the houses are more expensive without the wages being commensurately higher. So, you still see multiples of about 6 times in a lot of the north, whereas in London it's more like 14 or 15 times. And then you're somewhere in between when you venture, especially into the southeast, but the south in general, and actually the southwest, because if you remember, they had such a bull run as everybody flocked to the coast to buy properties in Devon and Cornwall when they were able to work from home, 2-3 days a week, which is slightly rowing back. It's certainly the direction of travel is to try and pull that back in industry by industry, although some will struggle and some are, I think, a remote forever, realistically. But basically, the Zoopla see the north up 0.5%, 1%, and they see the south down 1%, which is where their 0.1 loosely comes from. Go on, Safe, sorry.
Yeah, well, first of all, I was going to say I was late because I was reading the Sunday supplement, so try and shorten it down if you can a bit. Try and condense it down.
You're forgiven. Well done.
No, but the second thing, and all of this stuff is obviously really, really interesting. I love stats. I love the data behind it. What I'm trying to figure out for the layman's people over here as well is, what does all of this mean in reality for people? Because everything that you're saying is alluding to basically nothing very exciting in the market over the next, let's say, couple of years, for example, right? So there's not really much going on. But at the same time, where is the opportunity, number one, for people listening to this? And the second thing I would personally say is, is there anything exciting? So for me, I'm looking at things and I'm thinking, just visiting Japan, I saw a castle with two moats, basically. So I'm just thinking, is this creating more of an environment of pushing a lot of people out and reducing the number of landlords, which actually is quite an exciting thing if you're going to be holding on to property over the next couple of years, right?
Absolutely. I think you've teed me up nicely, because I've spent a good page at the end of today's supplement going through trying to stitch a lot of this stuff together, which I think is key, as you've said. So I think the other big point from Zoopla is around, it's the price levels where things are struggling. So 300k plus, they particularly identify as prices that are limping along somewhat, and it is just that extra cost of the mortgage payment is just too large for people to make those steps at the moment. And of course, on the other side of the fence, it's handcuffing people to their existing cheap rates. So that is very interesting. So, you know, I think that in a way, you've kind of always got two choices. If you're sitting in the southeast and you've got money and you want to invest in property, you've always had these two choices, really. You do stuff nearby, right? Or you go chasing yield somewhere, and you try and find someone based in places like where I am, where you are, maybe even further north. You know, that's the choice that you make. Now, at the moment, if you want to stay closer to home, the entire Zoopla say 40 to 50% deposits are needed pretty much everywhere across the south for buy-to-let, which cuts a lot of people out, certainly people who want double-digit returns, because by putting that much equity in, you're not going to be getting double-digit returns on your money unless you're buying insanely well, which, of course, most people do not have the luxury of being able to do. And we're talking really, really well. And the stronger the market, the London market has always been harder to buy true BMV in than somewhere like Grimsby or Swansea or wherever, with no disrespect to those places. You know, far easier, just because the percentage discount's a lot easier to achieve when a house is 100 grand rather than 700 grand. It's just as simple as that. So your lower yield stuff is now not an option at all. It can't be done for anybody. So if you want to stay local to where you are, what you've got to look at is your more active asset management, so HMO or short-term rental. And one of the things that tessellates nicely into that is that if houses at 300,000 plus are struggling, then it makes sense that they are likely to be bigger properties that are more likely to be HMO'd. And when Zoopla actually do a breakdown of where the price drop incidence is by number of bedrooms, and actually ones and two beds are holding up reasonably well, it's threes and fours that are dropping significantly, which is a complete reversal in the immediate post-pandemic trend for when people were looking for space to work from home, for example. So those houses make much more sense to making they're viable HMO conversions for a start. So that's one thing you can certainly look at if you're looking to stay closer to home. If you want to travel, you're having to force even more yield. So you're talking about going into 10+% yielding territories, which can be trappy, but can also be very profitable if you're working with the right team, the right people. Might be a social housing style HMO arrangement. You might be able to get that in a private let, especially if you're into buying multi-unit freehold blocks of flats or mixed-use commercial. So those are the things that are really particularly attractive. Now, of course, there's nothing stopping you going into those cheaper markets and still doing the active asset management strategies like the HMOs and the short-term rentals and trying to get the best of both worlds. But you've got a base cost to a room now, which is more significantly increased because the works are costing more, the bills are costing more, and the oil price is on the way up. So if we think we've seen whilst the price cap's coming down in October, the forecasts are that it's going to start going back up again from January. So bills and inflation, oil-linked inflation, we've not seen the last of yet. So I think that's what one thing people can do. Go on, Piotr, sorry.
I think that like you mentioned, they're going up north for getting the 10% yield, but I think we're like right now in the times where even in the southwest you can get 10% yields. Like you almost don't have to go away from home so far, because there are situations where we see 10% yields on properties in the southwest of England, and that's been unheard of. And that's usually a matter of circumstances where someone really has to sell. There's no one buying that property, and someone will pick it up with a 10% yield. And I think we see more and more of this kind of capital that's just waiting for the right circumstances, and then they buy properties that they wouldn't be able to buy otherwise. And this creates this kind of opportunistic environment where you buy properties that, very rarely you're able to buy at these prices.
I think the Southwest is a really interesting market because the Southwest is almost as confusing as London, as using the phrase London, because London contains so much in terms of, at the moment, inner is definitely struggling, outer is not doing so badly at all, as people are looking for a bit more value and going more suburban as the hybrid working model sort of entrenches itself a bit. Even if they're being pulled back into the office 3 days a week, suburban still makes sense rather than the 5 day a week. And there's a lot of anecdotal evidence. And I was in London on Friday, as Jay alluded to, got in quite early on the train, about 7 o'clock, a little bit later than 7 o'clock, walked across town to the city. So it's a good hike from Marylebone, as the King's English would call it, or Marylebone as the taxi drivers prefer. It's a good hike. It's just over 4 miles. And honestly, I've never seen it so quiet. The train was super quiet, even though the train before it was cancelled. And I was expecting it to be quiet because it's Friday. I don't normally travel on a Friday because Pip London is a Thursday, and the train is definitely still at the same sort of levels it was pre-pandemic from what I can see. But Friday, my God, it absolutely decimated. And I couldn't believe how quiet, not just the foot traffic either, the road traffic. It just seemed like a quiet city centre for a lot of that walk. And I just couldn't really believe it was even quieter than my expectations. So clearly the Friday, Thursday's the new Friday and all the rest of it, and the working from home Friday is clearly absolutely rife. And I'd be surprised if that's particularly rode back on. And I think some people who are very sceptical about how hard people are working from home see it as a bit of a perk. And whether a lot of work gets done then or not, I'm not really sure. But if business is done at the networking drinks on the Thursday night, I'm sure everybody's still happy if the hours are still being billed. That's the bottom line. But I think that's, the Southwest has got Bristol, incredibly expensive, very, very low yield, really, bats with Oxford and Cambridge and London as to its low yields. And then it has, reasonable sized towns like Yeovil, for example, where you've always been able to carve out those big yields. And then it has quite big swathes of rural stuff. And then it's got lots of holiday let stuff, some very top end resorts, especially in Devon, where you've got some really high per square foot prices. And it's just an incredibly diverse region, Piotr. And I think it's looking very cold on the 12-month map, but I think that's more overweight in interesting me this week. I was looking at the US market and how many apartments they've got coming online in the next 12 months, and it's a huge number. There's around about 600,000 apartments coming online, and I don't think there's going to be particular demand for them. And I think there might be some of that down in the Southwest, actually, where people have, development takes a couple of years. People started balls rolling in 2021 that aren't necessarily coming to fruition in 2023. So that'll be, and I'm sure we'll see the auction market pick up some of that slack as well. And I wanted to just divert for a moment into the auction side of things because, and then segue into the judging really, Jay, because I did get a chance to have a very useful and relatively long chat under my usual 87% contracted of the conversation. He was more like 93% of the conversation, but that was good because I was looking to draw some info from him. And a prominent London auctioneer, let's call him. Don't know if he's watching. If he is, then you know who you are.
I heard he was on absolutely top form, which isn't uncommon for him. So.
he was on top form, but he was saying, this is the new world of, because we were discussing. Someone had highlighted it in a group that both Safe and myself are in this week. Sutton Kirsch had a bit of a nightmare auction in Liverpool. They pulled about half the lots before they started. And that is a bit unnerving because the Liverpool market is one of those, going back to the Zoopla data and the profile and everything else, I've certainly heard and got contacts up there who are selling properties well in Liverpool at definitely not reduced prices. They're achieving near to full market for them. is it the start of a collapse? You know, that was the implication. But the aforementioned auctioneer was saying, look, this is just the new world now. We're working twice as hard to get the same number of lots that are realistic. We might end up with 300, and 100 won't get offered because we can't get the price down enough to get people interested. And then we'll still sell, you know, 160-ish of them. But the work rate, we're not going forward. We're struggling to stay still. And where you've gone from all the work being in getting the stock in because there wasn't enough there, it's now back to the old, try and get the stock in at the right prices. We don't just want wallpaper for the catalogue, but we're very, very close to the auction houses being very choosy again, which they haven't historically wanted to do. I mean, we discussed, didn't we, at length last week, the Allsops situation. And the 500 lots, although that is a bit of a one-off. And if an asset manager comes knocking, or you're not necessarily going to say no if there's a big disposal, especially when you're Allsops, you know. But it is interesting to see if you combine that with what I do think is interesting is if you combine the cash buys are only down 1%. Now, obviously, a lot of people do use auction finance these days, although they don't necessarily know what they're doing when it comes to bridging and all the rest of it, which is why some of the bridgers hang around at the auctions being helpful, saying, hi, we know you put the hammer down, we can be helpful. But one of the other things that I thought was really interesting was the discussion of the new world hasn't quite settled itself yet for how to actually make sure the online version of the auction, the hammer down, is as important as it once was. Because, you know, certain auction houses are using almost like a promise and card details and a bit of fresh air. Some are taking a £6,000 deposit, which is not the same as a 10% deposit, of course, mathematically, especially when you're auctioning stuff in London. Whereas I see the blockers, you know, some, I remember probably going back 18 months now, there was an auction where we were interested in about 7 lots, and the auctioneer wanted the full deposit for our max bid for all 7 in the client account. And it wasn't a small amount of money, you know. It was approaching 100,000 quid to transfer over just for the right to bid. Now, none of those are really bulletproof, and none of those are sensible. And the latter is going to put off a lot of people, I would have thought. You can do, of course, some of them do holds on debit cards or credit cards, but of course they're not. You know, if the buyer does get buyer's remorse, and the word was that more like 10% are getting buyer's remorse, where it used to be, well, you would know, Jay, but what, 1% or less maybe that did that sort of thing. And he's had all these.
We actually spoke at length about this on Friday at our Auction Buyers Club boardroom. It was a really, really good day. We had Paul Ribbons come and talk about his trading activity, and that boy can handle a room, so that was good fun. But I've been saying for a while, I don't know if you guys read it, but have you guys read the Property Auction Insight report from EI Group?
I've read it. Yeah. Yep.
The data on that is really good data. They manage all the data themselves. The only flaw in the data is they get the data from auctioneers. That's really the only flaw. But it's the same flaw that Zoopla had with getting data from HMRC Land Registry, right? Because Land Registry are terrible at providing data on commercial stock over residential stock, etc. Anyway, back to the point. I was basically saying that the number of people, because we hear about it all the time, we talk to auctioneers every week. We invite them to these events that we run. You get to natter at people quite easily, and they're free to talk because it's a professional environment. And I was saying to one of them, I said, I remember in a year, our fall through rate, if we were selling 100 plus properties every 6 weeks, we were doing 500 to 700 properties a year, which is no small things for a single office. I would say of those, maybe 30 or 40 properties were falling out of bed. It wasn't that many. Like the amount of people that were actually doing a runner, like the number of people that would do a runner from the auctioneer banging the gavel down when we're in the room and trying to run out the room before they got to my contract desk. Yeah, you can't help that. Maybe that would happen once or twice a year. Those were just completely anomalous. That was someone trying to better a situation. Normally it was stuff repossessions or bankruptcies that actually made it to the room instead of getting financed out. So it was probably someone that was connected to those properties that was messing up the
a spoiler, if you will. Yes,
the spoiler.
I
was saying.
Interesting though, on that, Joe, as well, there was I don't know if you've seen it probably. There's a trader that's been targeted specifically multiple times, probably 3 or 4 times, where someone's just bid up their lot and not paid the deposit. It was one of the online auctions where they don't actually put a deposit down. So that's happened just last week actually. So a specific trader that's been targeted for one reason or another, I think 3 times actually, or maybe 4.
I would expect that to continue, because what happens is people are getting burned by some. Not all traders are bad. We're traders, you're a trader. Not all traders are bad. We're good guys, right? But there are some that are really unscrupulous, uncaring bastards, right? And they're fair and few in between. But when they are, they're quite big. They're quite boisterous. They don't really care what anyone thinks. So what you've got here is probably someone they've screwed over. Maybe, someone's lost 20 or 30 grand to however much they stuck into their specials, or just by being, not willing to massage the deal to make it work. And that one person is probably making it their life's mission to screw that person's business over.
Well, Jay, you remember you remember the story of the one that we sold in London auction house. So just to put Adam into context and everyone else, we sold a house in London, or outskirts of London, Croydon, I guess. So 329,000 it sold for. So the deposit should be 32,900. But obviously it was a trader that ended up exchanging on the day, put down 5 grand and was one of these multi-bidder. So he obviously registered to bid on multiple lots just with 5 grand down. Now, anyway, the long and short of it was hammer went down. Oh, deposit's not in. Oh, we want 6 months to complete on it and a key undertaking. Well, they ain't getting that. It was back and forth. And anyway, the long and short of it was he was sat trying to negotiate after the hammer had gone down, funny enough, because he was going to back it and put it into another auction. Not to bore everyone with the detail, but I ended up looking at the big picture and thinking, well, I'm still going to make money at 329,000, a decent chunk of it. So actually, I need to get him to help me rather than trying to create a problem. And I was on a bridge, just bear that in mind as well. So I just looked at the bigger picture and I said, you know what? You can have 8 weeks and a key undertaking. I probably shouldn't have. I probably, should have just stuck to my guns and put it into another auction. It was also February when things weren't looking as great as well, 2023 that is. And he went on 2 weeks later, sold it in Savills for 364 grand. So there you go.
I think though, he was probably lucky with those 2 weeks, because look how rocky it's been. Nobody knew when what was coming really. So I think the prevailing opinion about that in Friday's chat was there's more of that sort of negotiating after the event thing going on, and the average vendor will just go, well, look, someone's bid it up to 330. Someone messes around or goes missing or this or that happens. If you can get the underbidder was at 329 or whatever, the underbidder might now move to 325 or something and say, oh, no, I'm not paying that much. But if they do 325, 95+% of the vendors are going to take it on the chin. Obviously, it's a bit different when you've got a trader selling to a trader. But like you say there, you can either make it a problem or you can come up with a solution that suits both parties. And that's what you did. I mean, for what it's worth, I think you did the right thing, because it's fair enough that if it had got into Savs, if that had been in May and then it had gone in June or something, it might have been a completely different result, 30k the other way. So that's the nature of the beast, isn't it?
We had a situation where possibly the same trader bought a property from one of our clients in the auction, and he had planning permission to convert into 2 houses, but he split this into 2 basically, even though planning permission was just 1 planning permission. And we were wondering, is it even possible to implement it? Anyway, he split the property into 2 and he put it back in another auction, and he put in special conditions. He basically charged the buyer for the architectural drawings that he didn't even do and that they were there from the previous sale. There's a lot of things like that happening, but
well, I think it's also just trying to look at, so one of the biggest trader in the country, and I've just been told about what he's doing to deal with this stuff. and it's as simple as he's got 3 of his best mates, which are probably the biggest litigators in the country, sat on standby. You know, this guy trades 50, 60 lots a month through auction. As soon as they don't take the deposit or whatever, they fail to obviously exchange with a full deposit, he just goes straight to them and he says the auction house is fine. But the most interesting thing is he's made the majority of his money this year on trades on failed completions. So he's got the deposits in, it's not completed. So he had one of these massive buildings based in West Yorkshire. You probably know where it is, but based in West Yorkshire, where there was an EHO order on the whole building, right? And I know people that bought some of these rooms, really not even flats, some of these rooms at £1 or whatever. And every time someone exchanges on it, they come to complete, their solicitor says, don't touch it. You know, there's this huge issue with the council going on. And he just basically made so much money from deposits. But then I'm looking at things, and I've had some really interesting chats last week with a lot of the traders. And they used to do a lot of the auction arbitrage model, right? Buy from one auction, sell it into another, similar to how the guy did it on the lot that we were buying, that we were selling. The thing is, that's not happening as much now for 2 reasons. The first thing is, most of the lots you're seeing going to the big auction houses are traders. You know, you're not getting Mr. and Mrs. Smith selling into auction nowadays as you were 2 years ago, whatever. And all you need to do is download the special conditions, and it will tell you everything you need to know. Trader. You know, just as soon as it goes over sort of 10 or 12 points, it's a trader most likely. And the other thing is, obviously, just in general, the market is swinging in the opposite direction. So actually, auction arbitrage right now is not as easy as it once was, because unless you can identify a major problem that you can solve between the 2 auctions, it's a tough market out there for auction arbitrage. So for a lot of the traders,
I think
I heard a story. And it's a bad story. I was talking to an auctioneer on Thursday. The auction and the auctioneer remain anonymous because I don't think the issue is unique to him and his auction. But he sells a property for Mr. and Mrs. Smith. It's a 3-bedroom end of terrace house. And the property is being sold with vacant possession. So on completion, place will be empty. Property goes under the hammer, sells under the hammer, everything's fine. The person who buys it doesn't ask for key access, doesn't do anything like that. Mr. Smith comes to 2 o'clock in the afternoon, 2:30, thinks, right, I'm going to go pick my daughter up from school. From his journey from his home to pick up his daughter and come back again, his locks had been changed. So the buyer wasn't asking for keys, just goes, okay, it's offered with vacant possession, went in and changed the locks. Sort of had to have broken into the...
Before they completed?
No, this was the day after the exchange. This is a day after exchange.
Yeah, before they'd completed.
So way before they completed. So the guy gets home, got his daughter in tow, wife's coming home from work, can't open the bloody door. Calls up the auctioneer, what the hell's going on? Auctioneer calls up the buyer, what the hell are you doing? The buyer's already on the other phone trying to list it into a London room.
Wow.
And thought he'd change the locks, he'd get his viewings arranged. Not only did he change the locks, but he did a video walkthrough with all of that owner's kit in there.
Well,
I tell you, I was sitting at the table talking with this auctioneer, and I was gobsmacked. And I was like, I've heard some stuff, and we've dealt with some stuff. Maybe
breaking and entering. It quite literally is breaking and entering. Yeah,
and documenting it.
Yeah. But Jay, did I tell you about? And this was not too long ago. Actually, this was quite recent. A trader sold a property. The buyers, he basically served notice 3 times on the buyers for one reason or another. Because of the way he did the trade, he was forced to use a certain solicitor, basically. And that solicitor said, yeah, sorry, the notice to complete 3 times we served, it was wrong. Anyway, long story short, they'd prolonged the complete, it was supposed to be a 2-week completion. They prolonged the completion by 12 weeks. In that time, the builder had gone in, refurbed it, put it on Rightmove. It was fully refurbed, ready to go by the time they completed. Simple as that. So there's a lot of this stuff going around at the minute, and people just got to be really, really careful with it all.
If it's done pre-completion and you haven't agreed to alterations or a schedule of works because sometimes you do that. We're negotiating a deal now where we're like, we'll exchange, give us X number of months. This is what we're planning on doing. This will be the schedule of works. here's the the correct things to do. If you don't do that, it's criminal damage.
Correct.
Yeah, I'm surprised. I think the one of the large landlords that I know who are very active in safes area. One of the things he puts into play is if a tenant misses a rent payment, they immediately get a money claim online, claim submitted against them. It's about the most aggressive you could be, really, in terms of rent collection. But he has an incredibly good record of getting paid. And I'm surprised if we don't maybe see more and more of this going on, where you do see people getting money claimed for the deposit, which may be what your friend with the 3 litigators is regularly doing. Could get relatively costly, but I'm sure it's relatively effective. And then they perhaps bargain down from there and say, look, you didn't pay your £6,000 or whatever. You haven't put it in Safe's case, the 33 grand hasn't gone in. But if you want this to go away without us pushing it to court and you getting a CCJ you can't afford, 20 grand will close the case and pay the legal expenses or similar, and use that as a new, these revenue streams that are coming in. I mean, it's one step away from the mafia, what you're describing. And I think it's probably the sign of the times, in that, as Safe was saying, things are tough at the moment. So people are aggressively trying to expand businesses, and I'm still yet surprised we haven't seen. It's probably because none of the traders have sold their souls to the man yet, but I'm still surprised we haven't seen various striped shirt brigades or whatever teaching you how to be a property trader. I think they struggle because very few people really understand it at the level where they could have this conversation. But I'm sure at some point, when they get hungry for new course fees, it's the next big thing, and it'll be the worst time to try and become one in some years, because
I have seen one go off last week. I think someone that's been trained by the striker guys. So let's put it that way.
Yeah, I saw someone trying to do the same. Yeah, it's probably the same guy. But I mean, one of the reasons why I think trading has escaped them for so long is because it isn't a no money down strategy. Even if you were to do 5% deposits, exchange delayed completion, or if you were to exchange and then refinance it almost immediately with a market value bridge, and you don't really put anything. I mean, there are ways to run it. Don't take any of that as financial or property advice. You shouldn't be doing stuff like that, right? I mean, that's super risky shizzle. It's not the kind of thing that you want to be getting involved in. But we had Paul Ribbon speaking at the event on Friday, and he said, I don't believe in passive income. He goes, I believe in massive income. That's why I'm a trader, because you create those capital events, right? And that stuck with me, because I've always gone, passive isn't passive, but I've never heard anyone call it massive before. So I'm down for the massive income. But it's not like a lot of people want to feel like when they're doing something, they have something at the end of it. And as a trader, there's no titles, there's no assets in the back. It's gone. If you're a sole trader, a solid trader,
you're either a trader or a trainer.
Yeah,
you're either a trader or a trainer.
Because I think most people start trading, then they divest some of that trading, or they do the 3-2-1 model, right? For every 3 you buy, you sell 2, you keep 1. Then you build an asset back in the background, but you can carry on trading off the back of that. I know a couple of guys that have done that, just so they've got the portfolio they have covers plus 50% their annual cost requirements throughout the year. Then everything on top of that is just trading profit.
Yeah,
so they use the platform to do that.
I look at it as the similarity between an estate agency and a lettings agency. Sales agencies can vary all around, and they're as good as your pipeline. And if your pipeline gets decimated by something, they're not really worth anything, to be honest. Whereas a letting agency is going to be the slow and steady and the boring, but it's going to produce that level of income, every month of the year. And so when your Q1 comes along and there's not been many completions because everybody's tried to complete before Christmas, or then isn't going to move until Easter, sort of thing, then that smooths that over. And that's why the two business models do fit well together, even though the skill sets you need are fairly dramatically different, And I think that is true. When what's a trader's retirement plan look like? They've got to take that massive income and have turned it into something, not Lamborghinis or whatever. And we've seen, and it's a very similar mindset to some of the more flamboyant developers, shall we say, where it's been great if you've done this project and that project, but if the next project is much bigger and you're all in on it, and construction costs go up 40% in the course of 18 months, let's say, real world example, you've lost a lot. You've lost a lot, you know, and you lose all your relationships and your ability to raise. It's like I watched an interesting YouTube yesterday about the US commercial real estate market, because there's a number of fairly prominent people saying that there are bigger problems coming, and this is all around the debate of, are these interest rates here to stay, or are we up briefly? Because there's still a decent school of thought of people that are like, I think it's going back down to zero. And then there's a few bits going around saying, I think the drop back will be quite rapid. Now, if you follow the inflation tracking stuff that I've been talking about, what's unlikely is a fairly orderly and rapid drop back to, say, 2% or below, right? It's either going to be, and I've put something in the supplement about this today, it's either going to be like it is today, shaving off a little bit, potentially for a few years, or there's going to be a significant event which drops rates back to 1% or lower. But the probability of that significant event is quite low at the moment. It's probably, so the point is, the average, if people are forecasting a rate of 4.2% in 1 year's time, no one really thinks it's going to be 4.2. There's an 85% chance it'll be 5, and there's a 15% chance it'll be 0.5, and the average becomes to 4.2. And that's what you have to try and sort of get your head around. You've got complete convexity around it. The two outcomes are here, but an average always appears somewhere in that scale in the middle. But it's not going to, the average situation is not going to occur. I wrote a supplement about this. I think it was right on the turn of this year, where I likened it to treacle. And like Saif was saying earlier, you know, that, okay, the stats and all that are really good. What do we do when it's treacle? But all I would say is, you know, we had a 2019 was a bit treacly, because there's still sort of the Brexit stuff going on. And then there was the election, which killed off the last sort of quarter of the year in terms of business. And the market was very flat in general. And the market did nothing at all. Fabulous year for trading along, because it was that, when, you know, at the moment, the taxi driver doesn't want to invest in buy to let. They're not telling you to invest in buy to let. That's probably a good time to be in. The time to get out is when they are telling you, oh, everybody's got investment properties. It's it's contrarian to be getting involved at the moment. But people, someone, a decent sized investor I know down in the southeast, has commented on the supplement today and said, you know, they're still buying, and they're either getting deep discounts or they're getting significant yields. And he runs a whole number of business models, including temporary accommodation, of which, of course, there's a massive demand for. And so he can do what I said earlier and stay local, but still get those high. And I said to him, in 5 years' time, I bet he'll be delighted that he's cracked on and bought heavily through this sort of period. He's doing more business than he was doing last year, you know.
For trading, like, there are different challenges in like good times and different challenges in bad times. But usually in the bad times, you can pick up such better deals, like you will turn them around somehow. You will do something good with it, because it's such a good deal, because there's no competition, or very little competition, for the kind of stock that traders are buying. But in the good times, it's way more difficult to pick up the stock that's at a good price, because people can sell to so many others. Other people.
That's what I always say to people. That's exactly it. Like, the last 3 years has been very, very tough for trading. It's been easy to sell. It's been so hard to fill the pipeline up over the last 3 years. Yeah. And actually, arguably, now is the best market to be trading, when you've got the highs and the lows. You know, you've got 1 month auctions doing really well, the next month auctions not doing as well for whatever reason. It could be sentiment, it could be all sorts of stuff. It could be the Bank of England, you know, base rate decision potentially having a 2 or 3 week effect, you know, post that. So I do think this is the best time to be looking at trading from a point of view of the highs and lows of the market. The market just constantly goes up. It's a difficult market to pick stuff up on. So yeah, I kind of agree with you. But I think, Adam, to your point as well, which is something that people aren't really talking about, you know, the spread between property price increase, if there is going to be any, and the rental price increase is huge. So actually, yields are going up. Yields are going up. You know, they're not compressing, they're going the other way. And I think that's something that people need to be looking at quite closely, is where are rents going up much higher than property prices right now? You know.
I think that's bang on, but I think you've got to just layer one nuance on top of that, right? And that is affordability. There's got to be affordability. So London rents now. London is always different from the rest of the country, as we know. But you know, in 2021, London rents sank really significantly because of the pandemic, and a lot of that was a lot of Airbnb units going back online, which was a very specific to London, right? Then what that meant is last year's rent rises in London were absolutely meteoric as the market completely recovered and inflation took it well beyond. And they've still been quite high, although inner London has started to lose some pace. But you are anecdotally very near the very, very top of the affordability in those areas. Whereas you can go to, I remember 10 years ago looking at the East Mids versus the West Mids. You know, I live in the West Mids, but I've done a lot in the East Mids. And the reason for that is the average salary in the East Mids is higher, still is higher than it is in the West Mids, but the average rent and the average property price were lower. Now, the average yield was also higher in the East Mids. So that was a complete no-brainer for me to think, hold on a second, this area's got, and sure enough, over that 10-year period, East Mids prices have done a fair bit better than West Mids prices, and they're now coming to near equalisation. But actually, the GDP and everything in the East Mids has done better, and there's still more headroom in the East Mids versus the West Mids. So if you can understand, and then you throw into the mixer significant infrastructure projects into that, I think you get the perfect storm of, you get yield, you get cap growth. You know, there's this, another classic mistake that people make is that it has to be a nice area for it to be kept, for there to be capital growth. Whereas just go and look at the ONS stats and it will tell you the truth about areas. And, you know, people are generally biased as to, when you ask them what percentage London has gone up, they'll normally overestimate it. When you ask them what percentage Stoke has gone up, they'll normally vastly underestimate it. So it's just using the real numbers rather than allowing any prejudice or bias to kick in that really show you you can get, and like you say, you correctly, you know, we've had even on Zoopla's figures, they see a 9% reversal in affordability. And remember, they're not accepting that the market's gone down. But when you get that into area by area, you really see the rooms where, you know, we always had 33% or more affordability headroom. I'm going back years when we analysed this, like 2015, 2016, right? But now, today, there's still 20% more affordability headroom, even at current wages. And the biggest inflationary problem, as the Bank of England see it at the moment, is that wages are still inflating. And I would just also put that into a longer term historical context. There's a lot of chat at the moment because everybody's obsessed with what's going on right now today, and they almost forget about the future, which is silly when you're talking about investment property because it's a long old game, right? But they're saying at the moment, right, it's been a huge, huge workers' market over the last 2.5 years. Salaries have gone up. You haven't been able to get people, blah, blah, blah. That's now over. This is the rhetoric that I'm seeing in the financial economic press. That's now over, right? Vacancies are coming down. You know, well, it's definitely and absolutely not over because there's still a giant hole in the working age population. Some from the Great Resignation, as we've called it, or the Big Quit, as they've called it in the US, and some from long-term sickness. And long-term sickness is still going the wrong way because the waiting lists are still going the wrong way. And these things take years to play out. And whilst you're on top of that, Safe, and you can see that trend today, and that trend is going to continue because, I mean, we could disagree by a few percent, but in reality, prices are going to be flat-ish for 12 months. I think it's fair to say rents are going to keep on escalating another 7-8% for 12 months, something like that. That's going to further fuel that yield characteristic. But the relatively lazy or slow or whatever you want to call them are going to read about that in an article that probably one of us writes in Property Investor News in 15 months' time. And they will have missed this boat today to buy these really good bits that do stack up when they come along, and it will be too late because people are reactive, they're not predictive, and they'll have sat on their hands and then they'll go, oh yeah, I wish I had done that now, but they won't necessarily be able to.
And contrary to your London visit last week, Adam, I visited Manchester. Probably not. I've not been there for a while, but it's absolutely like hustling. And you look at the city centre. It's millennials. A lot of it is Gen Zs, the millennials. And I was speaking to a few people that I know over there, and I was looking at all these high rises because there's a lot of construction going on in the city centre at the minute. And I'm like, who is buying or renting these apartments? And they're saying, one of them was saying, they know a 21-year-old that basically does OnlyFans. She clears $1 million a year. She pays $4,000 or whatever it is a month for her apartment. One of the penthouses.
That must be a good apartment in Manchester. That must. But I actually was in Manchester myself last week on Wednesday, because when we run Boardroom Club once every 4 months, we do a face-to-face one. And one of our members has actually got a hotel on effectively a lease option at the moment that he's running with his business partner in Manchester. Fantastic. We found a co-working space / short-term office boardroom rental for the day. That building was absolutely buzzing. I couldn't believe how busy it was. And look, it was Wednesday compared to Friday, but yeah, the whole of the rest of the city was absolutely alive, and you just thought, blimey, things look alive and well. But like you, I was struck by the number of cranes and the amount of construction there was going on. But of course, you've got to, build to rent, for example, is primarily focusing in areas like that. Big funds are primarily focusing in areas like that. And Manchester's stats have exceeded Birmingham's for the last decade, and it looks like it's got still a relatively bright future for 5 years to come. And of course, if you come out of the London market and relocate to Manchester instead of Birmingham, because obviously a number of companies have relocated to Birmingham, and there's a drive more towards it in the public sector as well, then $4,000 a month doesn't seem expensive at all. Actually, it seems really cheap. So I think there's a big swathe of young professionals who are in those city centre offices, who are still doing 3, 4, 5 days a week in the office, that are always going to want stuff like that. But the market will separate, and that's what I think we're seeing in a number of different sectors at the moment. It separates into brand new, all singing, all dancing, capex in. Fund is happy because they've got a 5-10 year view that city particularly is going to outperform or is going to do particularly well. And existing stock, where the landlords haven't really necessarily wanted to bother to do what they need to do with it, especially if it's office, for example, that is just absolutely struggling. And it will probably go towards something which we've not really had much of in this country, which you get a lot of in the US, where you've got a considerable number of empty office buildings. I walked past a couple, actually right in the city, right by where the judging day was, Jay. There was one that, I don't know if you saw it or you came from that direction, the Living Guardians. And I was thinking, blimey, that is some rent per square foot to have the Guardians in. That is for sure, because quite the location in the square mile,
You're on mute, Piotr.
We've got a couple of comments. I think they're quite timely to mention. So mention about the Northwest auction, the Liverpool auction. 2 big auctions last Thursday, Edward Mellor and Sutton Cash. Results, Edward Mellor 32 out of 80 lots sold, and Sutton Cash 43 out of 143. So it's like 30%.
But I think that's right down with last October's sort of results, isn't it? Post lettuce, that is right down there with them. And in a, if you were to choose a region of the country that still held up pretty well, that would be Northwest would be right up there on your shortlist, So that's pretty.
I mean, if you were to choose a region of the country that is an auction heartland and has been for about 300 years, you're knocking on the back door of Liverpool and Manchester, essentially, because they're staunch auction. They had more auctioneers than agents, 150 years ago. But they understand auctions. It's not a strange market like it is in London, where you have 50 agents per mile. And one auctioneer per 50 miles or whatever stupid thing is. It's random, but it's really strange that they're getting those kind of results or lack of results.
I also think as well, though, it's too much of a snapshot, isn't it? You can't just look at one auction at one time period. I think we need to be looking at trends, and we need to be looking at a minimum of 3 months. or 3 auctions in a row, really.
Well,
I agree with that. I'm big on
the EI group stuff, because they do this quarter versus this quarter last year, and one of their earlier reports, I think it was the one in February, you could go back 5 years measuring quarter per quarter to actually see where the growth was, where the trends are coming in at. I went to the Acuitas event. They had a market update on Wednesday. So Acuitas are a small, medium-sized, commercially focused auctioneer. And they were one of the things they mentioned that we mentioned here was about yield versus capital play. And they were basically saying we're expecting the yields to increase in terms of we're not going to be listing stuff at the 6-7% to be selling at the 4-5%. We're going to be listing stuff at the 10-11% to be selling at the 8-9%. And they're expecting that roughly to kind of carry on through to next year. And they were saying something about end of Q1 next year being really very interesting.
And I think this is a bit of a... Jay, just for 1 second, that is really the key to the commercial property market at the moment. Because if you take a really basic viewpoint, and it isn't correct because it's too linear, right, for the maths to be right, but if you were at a 0.1% rate, risk-free rate of return, so that you normally look at the 3-month gilt, right? If you were at 0.1 2.5 years ago, and today 3-month gilt is about 5.5, yeah. So the difference is about 5.5%. So therefore, in theory, all yields should go up by that same level of premium. Now, that would destroy the marketplace, and there would be a lot of loans that look very bad if that happened. And of course, it doesn't happen like that. It happens in a gradated kind of way, right? Now, there are some things that help with that. So in Resi, what supports that not being necessary? Well, massive rent rises at the moment, right? So that does protect the residential market as long as the affordability is still there, right? But if you look at an office building where you could argue rents are coming down, and that will depend city by city, et cetera, but if you could argue that rents are coming down because people don't need offices as much as they did, and it's going to depend on the size of the office and all sorts of stuff. But if the rent's coming down and the risk-free rate of return has gone up, that's double bubble, and it turns your 3% yielding office block, which I never liked, where people told me, but the rent progression's so good and blah, blah, blah. I'm like, I don't care, it yields 3% and it's not for me. Just go away. There's not enough. Where's your buffer? Whereas now that might become, well, hold on. In theory, that now needs to be valued at an 8% yield. But not only that, you're valuing it on 80% of the rent. I mean, that is a bloodbath. That's a 70% roughly drop in the value of something. 70%. And that's why commercial is risky. And that's why some of this we're going to see play out if we do see the treacle longer term effect of these longer, higher rates. If they're bumping around this sort of mark, it is going to be problematic for commercial real estate.
But I think you have to be really choicey with the commercial. Yeah, sorry.
Yeah. Sector by sector, absolutely.
Yeah. And this kind of times will help consolidating the market, because there's a lot of commercial property owners who have fairly low loan to values and able to borrow money at good rates. I mean, fairly good rates comparing to a normal typical landlord, but they're able to borrow money and then buy more property that suits their profile and suits their strategy and vision for growing the portfolio.
And this is that dichotomy between, at the moment, the biggest marker is, are you using leverage or not? Because some people need to have conversations around what does good debt versus bad debt look like? Because a lot of debt that look like good debt, to me, right now, looks like bad debt. And that's where it gets interesting. But you're quite right. We're talking low LTVs, and the bigger the organisation, the less they really care. But also, they've got a lot of non-recourse loans, whereas you don't see that in the resi market so much. So they can walk away from one particular asset if they want to, if it is an office block that's gone wrong. And I think that leads to potentially derelict buildings, which are going to take significant haircuts on what they traded at. So whereas the office per square foot went up like this, and the resi per square foot was going up at a slower rate, the resi per square foot might be static, but the office per square foot might be going like that. And there might be some interesting and large commercial conversion opportunities coming up. Would be,
I mean, one of the main reasons, and this is where the data kind of needs to be it needs to be cleansed a little bit, because a lot of office commercial values were shooting up, not for use as offices, but to be, converted into residential. So people were paying over the price point average for that level of commercial because they weren't willing to keep the commercial. So then everyone's like, but if you take out the WeWorks and the different types of working environments like that, where they overpay for their leases, artificially inflating the price of the underlying asset, commercial rental values haven't moved drastically, and property values in the commercial space haven't moved drastically, at least up until about 6 months ago. But you're starting to see now that yield is more important, which means the cap rate or the underlying value of the asset is reducing. And that is interesting to see.
Well, this is the thing. Even if they don't directly rely on the leverage because they're unencumbered or very, very low loan to value, these guys are sophisticated, so they can go into alternative investments where if a 3-month bond is returning 5.5% annualized, there might be a business case for them to put some of their money over there rather than keep plowing it into property. So we do need to bear that in mind. I know we're over the timing, and I know Safe is a stickler for the timing, even though he's a little bit late.
I was going to say, I think I'm fired, so you won't see one next week. Sorry.
That would be a shame.
Oh, brilliant. Yeah, another entertaining conversation. And got another comment from James, but we will respond in the comments in the section about the trading and difference between trading and developing and HMRC status of it. Yeah, brilliant. Guys, fantastic chat. Thank you so much. Great comments, everyone. Thank you for engaging, and see you all next week.
Thanks, everyone.
Good week. Take care.